I'm Cynthia Rowland, and this is episode 107 of EO Radio Show. Today's episode is the first in a series of technical episodes describing the basic principles of the tax on unrelated business income generated by organizations described in Internal Revenue Code Section 501c3. As most listeners are probably aware, 501c3 organizations are exempt from income tax generally, but this does not mean that all income generated by the organization is free of income tax. For most organizations, unrelated business income is defined as income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other exempt purpose that is the basis of the organization's tax exemption. In this episode, I'll talk about these defined terms, and in the next episode, we'll explore the modifications to unrelated business taxable income that provide exceptions to income items that would otherwise fall into this definition of taxable income. But these are categorically excluded because they constitute, generally, passive income. In the third episode in this series, I'll cover the exception to the exceptions for income that is debt-financed and thus generally is taxable income. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. First off, as we get into this discussion about unrelated business income tax, a note about resources for further information. Publication 598, that's Internal Revenue Service Publication 598, is the place to start for detailed information from the IRS regarding the tax on unrelated business income. Note also that the discussion today is focused on federal income tax implications of income generated from an unrelated business. Many states also have state income tax rules, and operation of these types of unrelated businesses may also affect property tax exemptions. Also, I'm focusing today on unrelated business income for charities, that is, organizations described in 501c3, which includes public charities and private foundations. But note that special rules apply to other types of tax-exempt organizations, that is, those that are exempt under other provisions of Internal Revenue Code Section 501c. So if your organization is not a 501c3, many of these rules will apply, but be sure to check for other specific rules that apply to your type of organization. So with that, let's talk about unrelated trade or business income. Unrelated business income is income from a trade or business regularly conducted by an exempt organization and not substantially related to the performance by the organization of its exempt purpose or function. Keep in mind that use by the organization of the profits derived from an activity does not alone make the activity substantially related to the performance of the organization's exempt purpose. So just because you have an exempt purpose that you use the net income for doesn't make the operation of the business a related tax-exempt income. So what is a trade or business? The term trade or business generally includes any activity conducted for the production of income from selling goods or performing services. An activity must be conducted with the intent to make a profit in order to constitute a trade or business. An activity doesn't lose its identity as a trade or business merely because it's conducted within a larger group of similar activities that may or may not be related to the exempt purpose of the organization. For example, the regular sale of pharmaceutical supplies to the general public by a hospital pharmacy doesn't lose its identity as a trade or business, even though the pharmacy also furnishes supplies to the hospital and patients of the hospital in accordance with its exempt purpose. Similarly, soliciting, selling, and publishing commercial advertising is a trade or business, even though the advertising might be published in the exempt organization's periodical that contains editorial materials related to the organization's exempt purpose. Now let's look at the term regularly conducted. Business activities of an exempt organization ordinarily are considered regularly conducted if they show a frequency and continuity and are pursued in a manner similar to comparable commercial activities of non-exempt organizations. This makes sense. The policy here is that tax-exempt organizations shouldn't be exempt when they're competing with commercial enterprises. That's the general idea. There's exceptions, of course. So as an example, a charity's operation of a sandwich shop for 2 weeks of the year at a state fair wouldn't be regularly conducting a trade or business. The stand would not compete with similar facilities that a non-exempt organization would ordinarily operate year-round. However, by contrast, operating, for example, a commercial parking lot every Saturday year-round would be the regular conduct of a trade or business. Next defined term. To be unrelated business income, it has to not be substantially related to the exempt function. So a business activity isn't substantially related to the organization's exempt purpose if it doesn't contribute importantly to accomplishing the exempt purpose. Whether an activity contributes importantly depends in each case on all the facts involved. In determining whether activities contribute importantly to the accomplishment of an exempt purpose, the size and extent of the activities involved have to be considered in relation to the nature and extent of the exempt function that they intend to serve. For example, to the extent an activity is conducted on a scale larger than is reasonably necessary to perform an exempt purpose, it doesn't contribute importantly to the accomplishment of the exempt purpose. The part of the activity that is more than needed to accomplish the exempt function would be an unrelated trade or business. Also, in determining whether the activities contribute importantly to the accomplishment of an exempt purpose, there are several important principles to keep in mind. First, selling products of the exempt functions. That's an important category to keep in mind. Ordinarily, a public charity that is selling products that result from the performance of the exempt function isn't an unrelated trade or business if the product is sold in substantially the same state it is in when the exempt functions are completed. So, for an exempt organization that is engaged in rehabbing handicapped or disabled persons, that being its exempt function, selling the articles made by its patients or clients as part of their rehabilitation training is not an unrelated trade or business. However, if a completed product resulting from an exempt function is used or exploited in further business activity beyond what is reasonably appropriate or necessary to dispose of it as is, then the activity would be an unrelated trade or business. For example, if an exempt organization maintains an experimental dairy herd for scientific purposes, the sale of milk and cream produced in the ordinary course of operation of the project isn't unrelated trade or business income. But if the organization processes the milk and cream in further manufacture of food items, such as, say, ice cream or pastries, the sale of these products is an unrelated trade or business unless the manufacturing activities themselves contribute importantly to the accomplishment of the exempt purpose. Another important concept to keep in mind is dual use of assets or facilities. If an asset or a facility necessary to the conduct of an exempt function is also used in commercial activities, its use for the exempt function doesn't by itself make the commercial activities a related trade or business. The test, as discussed earlier, is whether the activities contribute importantly to the accomplishment of the exempt purpose. For example, suppose a museum has a theater, which is very common, designed for showing educational films in connection with its program of public education in the arts and sciences. In this example, suppose the theater is a principal feature of the museum and operates continuously while the museum is open to the public. If the organization also operates the theater separately as a motion picture theater for the public when the museum is closed, that activity is an unrelated trade or business. So let's talk about some additional examples that might be helpful in understanding these principles. A good one that's highlighted by the IRS is a halfway house workshop. Suppose a public charity has a facility that's created to provide room, board, therapy, and counseling for persons that need extra support, say from addiction treatment or some other similar project. If that facility is also used to operate, say, a furniture shop or secondhand goods shop to provide full-time employment for the residents, and those profits are applied to the operating costs of the facility, the income from this type of a venture is not treated as unrelated trade or business because the shop or secondhand sale facility contributes importantly to the organization's purpose of aiding its residents' transition from treatment to a normal and productive life. Another museum example is helpful. Museum restaurant facilities are often a feature of the museum. So suppose an exempt art museum operates a dining room, cafeteria, and snack bar for use by the museum staff, employees, and visitors. Eating facilities in a museum help attract visitors and allow them to spend more time viewing the exhibits without having to seek outside restaurants at mealtime. This type of eating facilities also allow the museum staff and employees to remain in the building throughout the day. So for those reasons, the museum's operation of the eating facilities contributes importantly to the accomplishment of its exempt purpose and would not be treated as an unrelated trade or business. Similarly, museum sales of greeting cards are another example of an exempt function. Many art museums also sell greeting cards that display printed reproductions of selected works from their own or other art collections. These cards are typically imprinted with the name of the artist, the title or subject matter of the work, the date or period of its creation, and the museum's name where the original work is exhibited. Obviously, if the organization sells the cards in its own shop on site, the revenue from those card sales is not going to be treated as an unrelated trade or business. But what about selling them at quantity discounts to retail stores or by mail order? The IRS has long held that the fact that the cards are promoted and sold in a commercial manner at a profit and in competition with commercial greeting cards publishers doesn't alter the fact that the activity is related to the museum's exempt purpose, that is, educating the public about art and artists. Therefore, these sales aren't considered an unrelated trade or business. So here's another good example: pet boarding and grooming services. Many animal shelters that are organized and operated for the prevention of cruelty to animals also earn income from providing pet boarding and grooming services for the general public. These pet boarding and grooming services don't contribute importantly to the purpose of preventing cruelty to animals, and so the IRS generally considers those to be unrelated business taxable income. A final example to note here are school facilities. The IRS gives the example of an exempt school or educational institution that has sports courts and dressing rooms that it uses during the regular school year in the educational program. During the summer, the school operates a club open to the general public. Supposing the employees of the school run the club, including collecting membership fees and scheduling court times. Another exempt school in this example leases the same type of facilities to an unrelated individual and that individual runs the sporting events during the summer, while the lease is for a fixed fee that doesn't depend on the income or profits derived from the leased property. The IRS has held that in both situations, the organization's exempt purpose is the advancement of education. Furnishing these sports facilities in this manner doesn't further that exempt purpose. The activities would be treated as unrelated trade or business. However, in the second situation where the entire property is leased to a third party that then generates the operations, the rental income from leasing the property may be excluded from unrelated business income as passive income from real property. And we'll talk about that exception in the next episode. So now let's talk a little bit about reporting the taxable income. An organization that has $1,000 or more of gross income from an unrelated business must file the Form 990T, and that organization has to pay estimated tax if it expects its tax for the year to be $500 or more. I'll go into this in a little more detail, but keep in mind as we think about this, that if the exempt organization doesn't generate any net income, it still may be required to file the Form 990T, but if its expenses are greater than the gross income generated, the organization isn't going to have any unrelated business taxable income. So, again, as with any other income tax problem, if there's no net income, it's not really a problem. It's just a reporting exercise. So let's talk in a little more detail about the tax and filing requirements. All organizations subject to the tax on unrelated business income are taxable at the corporate rates on that income, unless they happen to be a trust. Exempt trusts have special rules, but I'm not going to focus on those today. The income tax is imposed on the public charity's unrelated business taxable income at corporate tax rates. The code is also clear that an organization that conducts more than one unrelated trade or business has to calculate its unrelated business taxable income as the sum of the unrelated business calculated separately for each unrelated trade or business. And so when calculating this sum, the taxable income from the separate trades or businesses can't be less than zero. The tax computed on the total unrelated business taxable income can be reduced by any applicable tax credits, including general business credits. But note that the organization that has net losses from one exempt activity cannot use those net losses against another exempt activity. So returns and filing requirements are pretty unremarkable. They follow the general corporate scheme. As I mentioned earlier, Form 990T is required if the sum of the organization's gross income from all unrelated businesses is $1,000 or more. An exempt organization files a single Form 990T. But the organization reports the income and expenses for each of its unrelated businesses on a separate Schedule A. So there may be multiple Schedule A's attached to the Form 990T. Generally, each organization must file a separate Form 990T except for certain title holding companies and organizations that are part of a consolidated return. But that's a pretty unusual scenario. So when to file? The Form 990T for a 501c3 must be filed by the 15th day of the 5th month after the end of its tax year. So for most organizations whose tax year is the calendar year, their 990T is due on May 15th, along with its 990. And like the regular Form 990, the organization can use Form 8868 to apply for an automatic extension of time to file the 990T, which is the same 6-month extension that applies to the regular 990. Now, keep in mind that there are public inspection requirements for 501c3 organizations. Public charity or private foundation that has gross income from UBIT of $1,000 or more must make its 990T return available for public inspection. Finally, a note about payment of the taxes. As I mentioned a few minutes ago, the tax-exempt organization has to make estimated tax payments if it anticipates that its taxable income will be $500 or more. Estimated tax payments, like the usual regime, are generally due by the 15th day of April, June, September, and December. If any due date falls on a Saturday, Sunday, or holiday, the payment's due on the next business day. Again, a typical rule. One final note, the IRS reminds taxpayers that exempt organizations and their return that prepare the organization's annual return, that is its Form 990 or Form 990-PF, and its unrelated business income tax return, that is the 990-T, should mail those in separate envelopes, and the supporting statements to the Form 990-T should not be attached to the annual return. So be sure you're working with an experienced tax return preparer if you have 990T that needs to be filed, so that you don't slip up on any of those fronts. So that's all for this episode. Be sure to check out the show notes for links to the resources mentioned today. Also, Farella, Braun, and Martel has a YouTube channel, and the nonprofit playlists for the EO Radio Show podcast organize all the past episodes to make it easy to find information on topics relevant to you. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun, and Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.